5, 4, 3, 2, 1. Ladies and gentlemen, good afternoon, or maybe good morning, or maybe good evening, if you are, depending on what part of the world you are watching us from. Today, I'm happy to invite you into the Introduction to Trade Credit Structuring Masterclass. This topic is becoming more and more important as we go in through our online events, and based on questions I've asked and our guests asked from you, from our audience, about credit management, about optimal terms of credit, and about credit management in general, I do find that it is important to explain in a simple and clear terms the importance and the process of trade credit structuring. Mainly because because I can see from the processes I see in different companies that the quite big and serious attention is drawn to assessment of creditworthiness and understanding of customer risk. But at the same time, many companies and many businesses around the globe really skip the importance, or really skip, or do not pay necessary attention to the terms of credit. And but paradoxically, terms of credit play at least the same role of significance in the whole credit process as creditworthiness of a customer, if not more. So let me just explain a little bit why it is so important. I suggest we start today from defining the task, or from the way the task of credit structuring or credit decision making, if you wish, defined in the real world. And we will see that in the end of the day, there is no credit decision. There is a decision of what terms to offer to a particular customer in a particular situation. Regardless, we have credit policy or we don't have credit policy. In the end of the day, credit policy is an internal document for the company, and credit is established between two companies. So quite often, our counterpart, either customer or supplier, do not care about our credit policy. There are terms, there is a contract between two companies which will govern relationship of the two companies in terms of credit. So how this normally defined for us credit managers, credit practitioners in the real world? We have a customer ABC, which is planning to buy from us for certain number of turnover per year, say 1 million per year. They expect credit term of X days, or let's say 30 or 45 or 60 days, whatever number of days. And then this is supposed to bring us $1 million, and then whether or not we will grant them credit. It is just obvious that there should be, every company supposed to have a process to answer this question. This might be, as I mentioned already, written in the credit policy or credit procedures, or both, or might not be. But nevertheless, we're supposed to answer our client something. And first question would be whether or not we are ready to grant them any sort of credit. And as I think every one of you clearly understand, this will be based on the creditworthiness of a customer. And it is quite obvious that the first step in any credit decision making or in any trade credit structuring will be assessment of customers' creditworthiness. There are many approaches to that, and actually every company decides whether or not this or that customer is creditworthy because, generally speaking, their responsibility for the final result will stay with the decision maker or decision makers if it is something like credit committee or similar to that. But regardless, any methodology, whoever says that, Andrei Sichko, even Edward Altman, or Gabriele Sabato, thanks to everyone. Like every single credit analyst can only advise on creditworthiness, but then we take this creditworthiness into account, and then we take a decision. That's one aspect of the question. Second, and most important, is that when we quite often we assess creditworthiness using model. Different sort of models. There are more advanced, there are less advanced models. There are approaches to assess creditworthiness of a customer, but we need to understand that every sort of credit granting presumes the risk of a bad debt. So what should we understand under the credit risk? We understand that there might be risk of a bad debt and there might be a risk of a late payment. But when we speak only about bad debts, we suppose to keep in mind that there are at least 6 different scenarios of bad debts. I will list them. They are quite simply. First of all, there is a scenario of quick fraud. So you ship goods, or you advance payment, or you do something like this, so you actually release your property to your economic value belonging to you, to your counterpart, and you would never see that. This is what is called quick fraud. Regardless, all the advanced systems we have in the world, cases like this continue to happen. Then second scenario is compliance. It might be simply unethical, or it might be simply illegal to deal with this or that specific customer. Therefore, we need to make sure we are compliant. And compliance risk, by contrast with even fraud, is even more important, because negative consequences in the case of materialization of compliance risk could be significantly more serious than the amount of customers outstanding. This is what we need to bear in mind. So, but on the other side, we should not need to. There is no need to invent a wheel or a bicycle, because there is already very well worked out KYC, or know your customer procedure. It is done in banks and done in financial companies and everything. So we can simply take it and implement in our processes. And based on the experience of what I've seen in many companies, I have a chance to speak with quite many of them. KYC procedure actually prevents most part of cases of quick fraud risk and compliance risk. Then there is that scenario is country risk. With country risk is actually the impact of the economic situation in the country or in the jurisdiction of our counterpart. So our counterpart, simplest example, our counterpart might have pockets full of money, or lots of money on their bank account, but they will be unable to pay us in the contract currency, which is normally hard currency like dollar, euros, or similar, just because of the economic situation within the country. And this will be country risk. There are others like political risk, like nationalization, and so on and so forth. So customer might be good. Customer might not be a fraudster. Customer might be compliant, but still we might have either substantial delay in payment or even a bad debt. Fourth scenario is self-explanatory. It is actually insolvency or solvency risk. I just highlighted the models above because quite interesting. Many companies are concentrated on the risk of insolvency because we have financials. But this is only one of the 6 scenarios. So solvency risk, obviously we look at financials and we understand how solvent our customer is. And then we understand whether or not we are ready to grant them a credit, or we might not have financials. Quite recently, we had a chat with the credit manager, with Jean-Francois Carbonel, who is working as a credit manager in Switzerland. In Switzerland, despite all the good things I could say about this country, customer financial statements are not available. The same story in the United States. So we have to take a decision whether or not we grant credit, having no idea about financial status of our customers, sometimes like this. Fourth scenario is actually long-term fraud. It's one of the most dangerous scenarios because normally it's intentional. We can explain it as intentional insolvency, where company owners or companies management simply take assets out of the business and leave creditors to arrange among themselves. It's quite dangerous. It's very difficult to distinguish insolvency and long-term fraud, but again, this happens. This is extremely dangerous to know. And on the other side, whatever financials company has, whatever good financials company has, whatever strong their balance sheet is, this type of fraud could happen. And sixth scenario is actually force majeure, is circumstances of unovercomable power, which could happen, like war, like military action, like change of the legislation, something which is not in the hands or is not under control of either party to the contract. And this is also a risk. And this is the risk which is leading to the bad debt. So analysis of creditworthiness is supposed to give us an idea whether or not we are ready to provide customer with any sort of credit. Again, taking into account at least these 6 type, or let's say subtypes of credit risk. Another interesting part of that is what units of measure we're supposed to use for creditworthiness. Because let's use our real life example. So if our potential customer is supposed to buy from us about $1 million per year, and they expect to get from us a credit on 60 days payment terms, 60 calendar days net, to be more precise. We're supposed to understand how much credit we have to provide them. So we're supposed to grant them. So how much money we're supposed to grant them as a credit? in case of $1 million, we need to divide it by 6, and this will be something close to 80 something thousand. No, not 80. So we divide it by 6, so it will be 150 something. So 150, this will be 900, so 150, 55 or 60 something, something like this. So altogether, this will be very, very close to $200,000. But then a question, how can we make a decision if we simply use a credit risk formula which gives us bond rating equivalent or default probability? Default probability, which will be like probability of default. Every one of you who works in bank would say that 10% default probability is quite high. But if we speak with a non-specialist, like I had a chance to speak with the sales director and saying that we cannot grant credit to this customer just because their default probability is above 10%. The sales director told me, whatever stupid this might sound like, but 90% probability that customer will pay is enough. For him, it was enough, and I had no argument. I had no arguments to say that. Other interesting side of insolvency risk assessment and creditworthiness is that default probability for the big company and for small company might be similar, but in one case, we're supposed to provide $10,000 credit or 10,000 credit. In other case, for the big company, we're supposed to provide $10 million credit. But default probability is the same. Therefore, summarizing all of that, it is quite useful, especially when we speak about structuring and when we speak about necessity to share our creditworthiness assessment and our future structure and consideration of the whole case with credit stakeholders like sales, like marketing, like general management, sometimes even finance. We need to speak a language which they understand. That quite difficult for them would be to understand, language of probabilities. Not all people in finance understand that. Language of probabilities, like, all statistics and everything. But therefore, in holistic credit management, we use another language. We use language of money. So we say that we define creditworthiness as an amount of money which could be trusted to a customer without any additional security. It makes situation quite more different. So we need to grant credit. In order to let transaction happen, we need to provide customer with, in our example, $200,000 credit, and then we define their creditworthiness, and then we see, okay, if their creditworthiness is 200 or more, the decision is quite obvious. There is no need to think too much on that. If their creditworthiness is below 200,000, then there is a risk that customer will not fulfill their obligation, and then we need to do something. In general, this is the beginning of trade credit structure. So we define creditworthiness, and if it is okay, if we are ready to grant credit in principle, then we consider how much credit it would be safe to grant to a customer. Then we go to the next step. In our example, I used 60 days, but then it's quite a good question to ask, why 60 days? Because every single day of credit term is actually increases our risk of non-payment. It's quite simple, and it is intuitively understandable concept that the longer the debt stays unpaid, the higher the probability that it will not be paid at all. But at the same time, the longer the credit term, the higher the exposure. So if, let's continue to use our example. If we grant our customer a payment term of 30 days, their potential outstanding or expected receivables or projected receivables, or their receivables in general, will be somewhere between 80,000 and 100,000. Not that much. But if we grant them 60 days credit term, their potential outstanding is growing to 200,000. And if the credit term will be 90 days, there will be already something close to 400,000. Or 300 or 400,000, and so on and so forth. The longer the term, the higher the exposure. So this is at least one, but not the last, reason for taking payment term seriously. Another important argument for considering payment term in detail is the cost of financing. Because every day our delivery or our invoice stays unpaid, puts on us, sometimes this is theoretical, sometimes this is practical, this is not the subject of our today's discussion, but every day we have a debt, we have to finance it somehow, and then we have to pay for that finance, and so we need to incur expenses. And actually, every day of credit is a cost. So the shorter the term, the better it is for us. Again, this is subject to discussion with the customer, but at least we need to consider that credit term seriously. And there are at least 8 important factors related here. So we need to take into account legislation. We need to take into account our company's position. We need to take into account competition. We need to take into account our margin, and we need to take into account our cost of financing. We need to take into account product shelf life. We need to take into account I said already, profitability and product shelf life, marginality, cost of financing. So all these factors supposed to be taken into account and retranslated into the potential corridor or potential range of optimal credit terms. This does not mean we should not go longer or shorter, but at least we know where the payment term is optimal, and then have a discussion with customer and align it. Knowing payment term, and similar to the example I already said, we can take potential sales and calculate credit demand, or amount of credit which required to be granted to a customer to make the sales or a transaction happen. We already calculated it based on 60 days payment term. It will be, in our practical example, it will be 200,000. Sometimes this is longer, sometimes this is bigger, sometimes this is shorter. And this, by the way, this parameter is called credit demand. So demand for credit. This parameter plays much more important role than only trade credit structuring, because this parameter is also very useful in an existing transaction, because when the sales forecast is changing, it's our good job and it's our great opportunity to recalculate it and compare the future credit demand with existing credit limit. And if we do that, we prevent significant number of issues we have in our credit management. If you are interested about that, please ask in questions, put this question in comments, I will answer it later. So we know credit demand, and then we compare two main parameters of credit for credit structure. We take creditworthiness. Let's assume we consider it the creditworthiness of our customer is 100,000. And then we compare it with the 200,000. And then we understand that there is a risk to lose some 100,000, whatever currency it is. And then we only decide what we can do with this risk exposure. In terms of classics of risk management presumes that there are 5 ways to deal with credit risk, with risk. Credit risk as example. So we can accept risk, we can reject risk, we can hedge risk, we can mitigate risk, and we can transfer risk to a third party. Unfortunately, big number of companies who structure their trade credit facilities for customers and suppliers do not see or only consider some of them, not all of 5, but very often it is necessary, or in general, the prerequisite of the right structure or the right decision is to see all the possible options. In this case, all 5. Acceptance of risk, in a practical example, is quite simple. We simply grant customer 200,000 credit line and take 100,000 credit risk. Rejection of risk, in this case, is as simple as simply granting customer 100,000 credit line based on their creditworthiness and forget about everything. Acceptance and rejection are straightforward. Mitigation. There are lots of instruments which are, meaning of the word mitigation is actually softening the risk or softening the impact of risk sometimes. My personal position is that mitigation is, is not very workable or very useful instrument, because in the end of the day, either customer pays or somebody else pays or nobody pays. Therefore, all these instruments which presume certain level of comfort or certain level of, like, we did something because we did at least something, is not really workable. A good example of that is reservation of title. You see, reservation of title is a legislative instrument or provision, or sometimes this is not. Often this is the clause in the contract that title to goods is transferred to customer only when they pay for it. However, this might be workable. This might be good to have. And in general, if you have a chance to add this clause to the contract, you better do. But in terms of practice, physical possession of goods has much more bigger impact on the result of the transaction than legal right to them. So reservation of title would be extremely workable when the insolvency proceeding is going on. Then you as a creditor could come and say, no, this stock of a customer is not belonging to them, it belongs to us, so it's supposed not to be distributed among other creditors. This is ours. But this is only in this case. In many other cases, reservation of title is just something which exists only on the paper. The same story with maybe with the diversification. Of course, the diversification of portfolio is important, and you might have less risk or lower risk on the portfolio level if you sell your goods to 100 customers instead of one customer. But at the same time, if the credit worthiness of one of these 100 customers is very, very low, and this one customer is extremely credit worthy, this not be the same thing. This will not be the same thing. These are two different things. So you just need to take into account that mitigation is good to have or is nice to have if you have it. But in reality, mitigation is not a protection from customer non-payment. Hedging is actually putting the limit to the impact of risk on the business. In terms of trade credit, the only way or the only comparison of hedging, which normally used in hedging instruments used in foreign exchange rates and other cases and other risks. The only hedge I found in relation to trade credit is actually bad debts provision. So when we understand, for instance, that we have to take our already mentioned 100,000 credit risk because credit demand is 200 and then 100,000 is credit worthiness of a customer. So we are granting credit to a customer and we are taking 100,000 credit risk. So what can we do? We can simply grant that, as I said, simply accept, or we can book a bad debt provision in advance. Thanks to new IFRS accounting principles, we can do that exactly before right before the first shipment to the customer. We can simply do that. And we book 100,000 bad debt provision. And this, if customer will fail to pay, will not affect our business because we immediately reserve our cash and our profit, assuming that they will fail. Later on, if they will not fail, if they work normally, we will reverse that provision or keep it for some time. But at least in case of the failure of the customer, in case of the bad debt, the impact on the business will be already reviewed, already prevented. This is called hedging. And finally, the fifth and the last way to manage credit risk is transfer it to a third party at a fee. Here we've got quite big number of ways or quite big number of instruments, starting from first, wide known bank guarantees, letters of credit, standby letter of credit. We can speak about credit insurance. We can speak about, assignment of receivables, pledges, many instruments. There are at least 16 of them, including also escrow account and so on and so forth. So we transfer a risk to a third party at a fee. So the general thing of all these instruments is that we sign one more contract with, let's use bank guarantees as a simplest, maybe one of the most simplest, let's say easiest to understand. We sign a contract with the bank, normally it's our customer who signs the contract with the bank, and bank provides us with a bank guarantee, but the bank guarantee is sort of contract, which guarantees us from non-payment of the customer. So if our customer does not pay us or fails to pay us, there is third party whom we can claim that debt, and they will have to repay it to us. The terms will be different, the price will be different, but in the end of the day, it is extremely important to have that protection. And in general, when we understand that we take this risk, 100,000, so we ask our customer to provide us with 100,000 bank guarantee in order to provide them with the credit which is required. This is extremely creative part of credit management as actually any other. And this is why it is called structuring, because if we take risk, we decide what to do that, and then we need to find the right instrument to cover credit risk. There is way to do it, but in general, we're supposed to take all available options. Again, all available options out of 16 trade credit security instruments. There might be only 2, 3, or 5 or 10 available, and then we choose optimal one and align with the customer what it will be, what the instrument it will be, what are the terms of this instrument, and then we make sure we receive it. Another important topic here with the use of trade credit security is that we supposed to assess the creditworthiness of the security provider. Because it is not just enough to have somebody who will pay on behalf or instead of our customer if our customer does not pay us. It is important to know that this counterparty whose guarantee we accept is creditworthy or creditworthy enough to pay instead of our customer. This is another part of work, but again, this will be sort of creditworthiness assessment, which supposed to be done before we accept this or that part or this or that instrument as a trade credit security for our transaction. And finally, and this is the step which is often overlooked by the creditors or by trade creditors, is the final step, is alignment of terms, alignment with the customer. And it is of the same, if not higher importance and than as any other of previous steps. So we assessed credit risk, it was step number 1. We defined optimal payment term. This was step number 2. We found or we estimated the credit demand. Then we found what would be the optimal credit security to be used. And final step is alignment. So altogether, we need to sit with the customer or with customer's responsible personnel and align what's going to happen in each and every particular situation. What's supposed to happen if they don't pay? What's going to happen if they exceed credit limit? What would be the mechanism of use of the bank guarantee on, let's say, if they don't pay, or the bank guarantee or credit insurance, and so on and so forth? Every single detail. I'll give you an example, because deviations between between our understanding of a term and understanding of a term by our customer could be substantial. It could impact our risk, could impact our business really dramatically. Once I received a request for credit, which was already approved by our management, to establish a credit limit of $5 million. Okay, well, management decided $5 million, 90 days payment term. I said, okay, as management already decided, why not? So we established that and we started to ship to a customer. And after 3 months, we found that credit limit is completely exhausted. And then there is new order coming. We recommended our colleagues who were dealing with this customer that maybe customer will pay. Otherwise, we cannot ship to a customer because the credit limit is completely exhausted. Then they say, although they cannot pay. They cannot pay because they are state monopoly and the credit term is different. I said, what does that mean? Different. You wrote in the credit request 90 days. So when we finally took a contract and read it carefully, we found that 90 days, as they wrote in the credit request, was actually 90 working days upon delivery and inspection. And delivery was from Switzerland to Asia, to, well, if I'm not mistaken, to Malaysia. So this actually taken altogether 90 calendar days written in written in the request for credit. In practice, in understanding of a customer was very close, was very close to 180 days. Really double. But no one took care to discuss that with the customer and to understand. So alignment of credit terms is extremely important, it's final and extremely important step. In the end of the day, we discuss three main terms, as you might understand. So we discuss the payment term, we discuss the credit limit, and we discuss the security requirement. Three main components or three main details of customer credit structure. And then we only update them if necessary. This is structuring, and there might be also other important provisions like payment discounts, like sharing the cost of trade credit security, and many others, again, subject to discussion with and alignment with the customer. Obviously, all this job, it's also important, needs to be done before we sign the contract with the customer, as I said in an example I said outlined above. Because if we sign contract first and then start to structure the deal, it's already too late. It will be already too late to review payment terms, credit limit, or anything like that. So in the end of the day, these 5 steps are generally done in order to achieve one very simple thing. Be very honest, business has, I could not say business does not need a credit manager, but it's about holes in the wall. When classic of marketing, Philip Kotler was trying to explain what is the meaning of marketing is understanding of customer needs. And he said that when somebody is buying a drill, this person does not need a drill or does not need to possess a drill. The person is buying holes in their walls. So holes in walls provided by credit management is actually the structure under which customer simply buys goods, pay for them on time, and order again. Only 3 steps. And this is supposed to happen with minimum interruption of credit management. So we just need to find adequate terms which allow customer to do these 3 steps and spin them as long as it is possible. And if it doesn't work, we need to review terms and make them, again, this cooperation between 2 companies as smooth as possible and work and generate cash for both parties. So when we say in holistic credit, when we ask what is the best customer structure or customer setup, we answer silent. Customer setup or customer structure, payment term or credit terms of credit must be silent. They just work. That's what I wish you to achieve. I actually done for today with today's lecture and explaining an introduction into the trade credit structure or trade credit decision making. Couple of announcements about that. If you wish to learn deeper trade credit structuring or trade credit decision making, there is a course on Udemy. And by the way, this lecture will be part of it quite soon. So if you wish to learn about it, you can go on Udemy, find trade credit decision making, and join the course and learn and understand that in deeper, because there are provided some more details about trade credit structuring is provided there. If you wish to learn deeper on and wider about the holistic credit management, there is a course, Credit and Accounts Receivable Management, which we hold together with the International Alliance of Professional Business Elites. And this is diploma course, so you, upon receipt and sitting an exam, you receive an international qualification in credit management. So if you wish to join it, there will be a link in the description or in this event. So please join the course, and there we will learn how to structure the customer and how to build the whole credit management process or whole credit function within a business. And if you also trade credit structuring, if you want to have somebody to help you to structure a specific deal or assess credit worthiness or do portfolio analysis or whatever else your credit function might need, like specific tasks, credit engineering is exactly for that. So we also got our outsourcing win, which is helping companies, for instance, with structuring of terms of trade credit terms for a specific customer. I really appreciate your active participation, your passionate listening, and for finding time. I'm really grateful for you for finding time to join us today. As a matter of tradition, I wish every one of you highest possible sales, lowest possible losses, or as it could be said in French, bon crédit. See you around next time.